So we have a question here from one of the members of the Discord. Could you talk about position sizing on a smaller account and how that changes as you grow the account? Yes, I can. This should be your 3 big takeaways. Start small, play into winning trends. Defense is your best offense. As an example, we'll use one of the option plays that I posted in the Discord, like this American Airlines put play that I set up on the 13th. So let's actually look at how that play went for me. We brought right here, the stock actually ran against me in the short term. Now it went 34% in the red, which is usually my hard cut range. Look to re-enter in a different position. Now lucky for me, the trend that I was looking for started to play out before I hit that hard cut range. When I start having a winning position, it looks like the trend's caught on. It's now in my favor. I'll average in, I think about 20%. I started buying more aggressively on those contracts. So when I went to break even, I was actually in profits. And then we went from profits to up 25% to up 30% on the position. But keep in mind, I'm not up 30%. I'm up more like 40 to 45% because I averaged into my winner once it started going in my favor. Now let's just assume that I have a correct thesis on why I set up this trade. I'm not going to break that down. This is more of the management of the account, right? So we're caught the trend. The trend's now in my favor. The difference now between a small account and a large account is a large account, I can let the position roll, continue to play into my winner, and maximize my returns as the trade plays in my favor. On a small account, though, it's going to be really important to lock in profits. I don't want to lose this money. We don't want to be taking losses, and I didn't have enough money to average into it. This position's now 20% of the account. It's a large portion of the account. Need to be cautious of that. So what I'll do is look at the option chain, right? We had this $16 put. It's about $67 now. Bought it for like 40. It's about $27 per contract profits. So I'll be looking to say, okay, I could sell these, take the profits. If let's say I'm just have one contract. If I have just one contract, I might be looking at these 14 fives. I can buy those with just my profit, still get exposure to the stock. What I'm also doing there is I'm trading that 0.4 delta for a 0.18 delta. All right. So if the stock actually runs $1 against me, I'm not losing 60% of the contract. I'm losing 50% of the contract, and I'm losing only 50% of the profits I made, still taking home some profits. All going to be about risk management. Now, let's say there's a scenario where I had, 5 of the $16 contracts. And so in that case, maybe I just start unloading some of those and I go ahead and I keep that position open and I don't roll it. And that just all depends on where your target is. Okay. Time frame target going to be a huge deal. And in a smaller account, probably going to need to do more micromanaging. There's going to be a straight line to my target when I have a larger time frame like this. So if I'm rolling down, I give myself some more room to do some more managing on that. This decides to bounce back up and make a double top. Hey, I'm not losing much on the way in, and then I can come back and maybe even reset my original position, constantly making sure that I'm locking in profits along the way.